I'm Keith McCullough, and welcome to another Real Conversation. I'm excited about this one. I've never had a real conversation with Steph Pomboy, but I'm excited to. I've watched you from afar, Steph, for a longer time than I might have to admit. When I was on the buy side, you were at ISI, and then you started your own thing. So
Wow.
I am excited. It's like I'm meeting a bit of a macro superstar. She runs MacroMavens, of course, for those of you that don't know.
Well, I'm the one who feels like I'm having a brush with celebrity here. So I've been watching you on all of your various financial media outlets for a long time. So I'm very much honored to be here today and get to chat with you.
I think it's gonna be a really good opportunity for, there's lots of noise. Obviously, there's a big pump machine going on behind it all, and I infrequently have an opportunity to have a peer, so to speak, that analytically can go back and forth with and talk about the things that I'm looking at. Because sometimes, quite frankly, I've woken up in the last couple months in particular, Steph, where I'm like, am I looking at the wrong economic data? Am I missing? Did they chop off half of the time series in the chart? Is this going to end well?
Right.
And your work, what I love about it is that you, unlike a lot of people, who would maybe even hinge idiotically on something like the retail sales number from yesterday being up 17 sequentially.
Right.
You actually pull back the time series as far back as anyone's work as I've seen, and I think that that's what gives you, or seemingly gives you, confidence in your process. Can you talk a little bit about your process? Like when you're looking at something economically, what do you start with?
Well, I guess, being a top-down, big picture person, I start with the long-term macro backdrop, which really is sort of talking about major secular trends, and I'm trying to figure out where we are from a secular standpoint, and then I look at what's happening with the economy in terms of cyclical swings around those secular patterns. So, for example, right now we're kind of going through the end, or I would argue we did already end, and we're now reversing the pendulum swing from globalization toward isolationism. And then, how is that going to impact monetary policy globally, and what does it mean for currencies and that sort of thing? So I try to start with a very long-term perspective, and then, keep that in the back of my mind as I look at what's happening day to day, and have that broader context. I mean, I do think it's important to have some historical context to put these numbers in. But of course, as you said, these days it feels like, if you remember what happened a week ago, you're really doing yourself a disservice. So it's, you say you wake up and you feel like you missed something, and I feel like I never woke up. I must be dreaming, because I couldn't ever imagine seeing some of the things that we're seeing today.
Yeah, I mean, if you're a student of history economically, I mean, you have quite literally never seen rate of change moves like this within, like, I love how you put it too. It's the cyclical, for those of you that don't know, that's the intermediate term, and the super long-term secular. I mean, these are alarming, would be like a very polite way of putting it. But what another thing that you did when I was reading your notes quickly to just get ready for this, you actually called it the unnamed catalyst. I've been looking for ways to articulate. I mean, I'm really trying to name it different things, use better metaphors. I'm running out of them. But what I kept saying was, hey, what happened at a particular point in the U.S. economic cycle that could have been anything. It just made it happen faster. Is that basically what you meant by an unnamed catalyst or not?
Absolutely. I mean, you and me and people who, like us, who actually think about the longer term consequences of the last decade or 3 decades of monetary policy that's basically built this enormous leveraged economy, have been sitting here waiting for what's going to be the thing that pricks the corporate credit bubble and causes it to burst. And, I had my own ideas as to what they would be, and a lot of them were rooted in the fundamentals, looking at earnings growth for S&P 500 companies, and the idea that those would be disappointing going forward. But ultimately, it ended up being coronavirus. But the important takeaway is the same, and that is, it's the coronavirus crisis is just one little small story in a much larger story, which is going to be unwinding of this corporate credit bubble, which I guess we can, talk about if you want to go there. But
Yeah, I definitely do, because I mean, you unlike me, I mean, you tied it to, I think you called it the Great Pension Crisis, which is, again, when I read that, it's uniquely tethered. Of course, anytime we're talking about a corporate credit bubble, we're talking about the rate of change of the cash flow cycle, and we're talking about a lot of different things. But I didn't quite take it there. So why don't you go there? I also liked how you did it in two different acts. I thought that was beautiful. I was like, you dumbass. Like, I still struggle with the dumbass, in terms of communicating. I swear to God, I've used every metaphor. I'm out of them. This was a better one.
Yeah. Well, I mean, it seemed clear that you would have this myopic focus on the coronavirus as the reason why we're going through what we're going through exclusively, and, ignoring all of the legacy issues that we came into this problem with. And then, once it looked like we were getting through the worst of the virus, that people would get excited about the economy reopening and 18% rebound in retail sales and all that kind of stuff. So you'd have this intermission after that first act where the markets would go bananas. To be fair, I never thought they'd go quite this berserk. And then, my sense has been that we're going to come up on the second act in this drama, which will be when the corporate credit issues are revealed to still be in place, that, we haven't actually solved the problems, and that we're going to have to still wrestle with all those legacy issues that have largely been forgotten. But as it relates to the pension crisis, I came to that, Keith, kind of backwards, and that is that I've been watching this pension funding deficit since the global financial crisis. As the stock market went through the longest and largest bull run in the history of mankind, the pension deficit shortfall, both, for the total economy, private and public sector pensions, the shortfall continued to grow. And I thought, this is staggering. Why is no one focusing on this? We've had, rampant asset inflation, and yet the shortfalls are mushrooming. And obviously it was a function of the Fed pushing rates down so low that it swelled the liabilities of pensions because it discounting at, lower and lower, or effectively zero interest rates. But, the question is, what's the alternative? If you raise rates, you're going to prick the asset bubble. And so that's not going to solve the pension crisis in any way, shape, or form. But the reason I kind of dovetailed that with a corporate credit bubble bust is that obviously if you're trying to make a 7 or 8% return in a 0% risk-free world, you have to hold your nose and go into the darkest, sketchiest corners of the credit risk market to get anything close to that return. And actually, funny you bring it up, but I guess it was a couple days ago, CalPERS announced a shift in its strategy where they're now going to increase the leverage in the pension fund so that they can try to generate these 7% type returns. So there is a recipe for disaster. Wow. If I ever heard of one. And that's CalPERS. Usually they're the trendsetter. Where they go, everyone else, follows. So we can look forward to some delights on that front. But, the reason why that is so crucial, in my view, is that the pension funding shortfall today, or actually as of the end of the first quarter, so March 31st, was $7 trillion. I mean, these numbers are hard to even fathom. GDP was 21 trillion. So, that's where we are as of the first quarter. Imagine what happens if we do have the deflation of the corporate credit bubble and these guys, all the risk assets that they held get marked down, 40, 50%, pick your number. What's the deficit going to be then? Easily double digits.
Well, I think that's, the math, and we will show the rate of change math on that, because I do think that unless you don't believe in gravity, which I'm still a big believer of, And some people don't. Like the things that I'm sure you hear from clients, and respectfully, we have to have those discussions with them. But it's almost like the anti-gravity machine that I'm hearing from, which they quite simply believe that they can bend and smooth gravity, eliminate the cycle. And in some cases, I actually think I'm hearing them say that they're going to mark the credit bubble to model, like Dick Fuld would have, his level 2 or 3 assets, like flaming pieces of shit that are going bankrupt. The Hertz example, now people actually understand it because they lost money trading it. I mean, normal people. But Wall Street people, I'm having a hard time, and I mean this sincerely. I mean, sometimes I'm being sarcastic, obviously, but I am sincerely having a hard time trying to understand if there is a conspiracy theory on the buy side, because that's where the real problems are, and trying to mark that to model, and using their connections to Powell and my former, I was at Carlisle. I get the whole connection, the web. Like I'm wondering if it's like they understand what you and I are looking at,
right,
and they know it full well, therefore, or they don't know, which is worse,
right,
and they're setting it up for the mother of all collapses. Is it either or? I don't know how to answer that in my own head.
Well, it's sort of like a variation on the question about the Fed, and do they realize that they're in this bubble where they can't raise rates and they have to keep printing money, or are they really that obtuse, that they just continue to repeat the same thing? Essentially, I think you have a better window into those people, given your background, as to whether they're intentionally pursuing this artifice or not. But it does get to the broader question of the sustainability of it. Can they, like you, I believe in gravity. My face clearly believes in gravity. So, sadly. But, I feel like at some point, the jig is going to be up, and try though the Fed is, for example, to say, look, we're going to keep this credit market held together with everything, every day they come out with a new program to support the market, such that you're really penalized for worrying about whether these companies really will be solvent 12 months, 24 months down the road. And so the idea is, can we create the destiny? Can we convince people that things are fine to the point that they become fine? I guess if you can maintain the lie long enough, then people forget that it's not true.
Mm-hmm.
I guess now I'm kind of going down the rabbit hole on this, but it does seem to me that the real wrinkle in this whole, whether it's intentional or just blind ignorance, the wrinkle in it is that for all the things that the Fed has done to backstop the corporate credit market, you're still seeing unprecedented amounts of downgrades of various issues across the credit spectrum, but most remarkably, obviously, in the junk and low quality space. In the levered loan market, that's failed to be resuscitated by the Fed's efforts. So you're getting, lower issuance. The default rate in levered loans is the highest, I think, since 2014. So the weakest links in the chain are breaking in the credit market already. Mm-hmm. It's just they haven't done it in spectacular enough fashion to get everyone else out of the market yet. I think right now, maybe they're still in that sort of Bernanke isolated and contained delusion. And it was going to take a little more pain in those weaker links before the problems ripple, as they always do, further up the credit chain.
Yeah.
I have never seen a cycle where, junk or levered loans, whatever products you want to look at, CLOs, have had issues and it hasn't infected the investment grade market to some degree.
Mm-hmm. That's the gravity that I'm talking about. We'll go through, we have 6 charts from Steph that I think will illuminate things for you if you haven't looked at them already. And I do think it's a great disservice that whoever the media now is in financial markets has not quite articulated this as beautifully as she will. But the reality is that these are time series that exist, and they quite haven't gone away, these relationships. And the gravity of the cash flow situation, I guess that's just it. I mean, to me, they've actually pulled more people in. Like when you get a bunch of hoodies or whatever you want to say, people at home buying Chesapeake, buying Hertz, losing a shitload of money at that with, buying bankrupt companies. Like they've already announced that they're bankrupt. I mean, now you have a lot more people. You've actually, through your own, I guess, ignorance. I actually do think that they're still academically ignorant, because it is based on the premise that they can bend and smooth and or eliminate economic gravity. That is, to me, I don't think that that's a conspiracy theory. I know that that's how they talk. You're Dartmouth Econ, I'm Yale Econ. We know these people. And that I've always thought was going to be the end of it, was that they are going to fall on their own sword, but until it ultimately happens, it's going to have to happen in a lot of different ways. Now, on that, like when you look at, for example, some of these, I guess, responses somebody would have to that. And I don't want to make this as idiotic as some of the tweets that I get, or even some of the institutional comments, like, Steph, don't fight the Fed.
Right.
Like, what do you, like, I have a variety of answers to that now, which I'm not going to go through, but what is your...
Keep it clean.
Yeah, I mean, let's just start with the back test. It's a coin toss, depending on when it is that you're saying that. So, I mean, that's just the history of it all. But what do you say?
Well, I mean, I guess my answer is probably not dissimilar from what yours would be, and that is to say, look, the timing is impossible to get, but I can't tell you how many times people told me not, to fight the Fed when we were at the peak in 2000 and, in 2005, 6 with the housing bubble, and everything's great. Just, get with the program, man, and clearly, I looked like a complete first-class moron for a while. And then ultimately, you just don't want to be there when the gap between perception and reality is resolved. It's much better to miss out, obviously, on this kind of irrational exuberance, blow off top, whatever you want to call it, as good as it may feel to the people who are rushing in. Much better to miss the last 10, 15, even 20% move if it's going to spare you getting hammered when it's down 50. And actually, when you look at simple measures of valuation, like the old market cap to GDP measure, 50% is exactly what is implied now to return to normal valuations. I mean, do you think any of these David Portnoy followers are emotionally prepared, much less financially prepared, to take a 50% hit on the money they're throwing in this market? I mean, I can't imagine anyone's got that on their radar screen. Yeah,
so. And I might add, nobody had it on their radar screen when you did in 0001. That's when I first, because again, I was a buy-side analyst, and you were, I think that's when you were at ISI or about to start MacroMavens.
Yeah, exactly.
And it's not the girl who cried wolf. It was true, and again, in 07 and 08, and again, every single time, what's interesting about this to me is that, that one, of course, 0001 was the combined or combo of a credit bubble and a tech bubble. The 07 one was on bank balance sheets, as to your point, was a housing bubble. But again, it's increasing leverage to the individual. But now we're back to the old corporate bubble with a tech bubble. So I mean, it's and of course there's no bubble in venture capital or private equity. And I live in this great state of Connecticut where everybody's a raging Republican and a free market private equity person that is okay with taking their marks, right? No, Keith, don't come to our parties. And those were great parties, by the way. Private equity had much better parties than hedge funds for the last couple of years. At
I wouldn't know. Yeah. I wasn't invited to any parties, Keith.
Well, hedge fund returns by and large sucked, particularly if they were macro people. So, but private equity was living large, and doesn't want to stop living large. And I wonder on that front, I mean, how much of it and we will go through these charts next, but how much work have you done on what you can't see? Because that's the part that my analyst team were working on. Like, what part of private equity leverage? Like, can you quantify the stuff that I can't count that's not publicly traded?
Gosh, I wish I could. Not even going to venture a guess on that. I mean, I'm already terrified enough when I look at the charts on, the amount of corporate debt that's trading at distress levels, and the cash positions of average corporations, and the potential for where the default rates could go. To say nothing of the 7 trillion in pension underfunding. I mean, I'm plenty bearish. I don't know if I need to layer on top all of the stuff that's going on in private equity. Although I think one window into that has been obviously what happened with the unicorn stocks, which of course, nowadays it's news fast. No one even talks about the unicorn stocks, but that was really the whole private equity deal there. But it also gets into the pension funding thing, because that, alternative assets has been another category that pensions have glommed onto to try to make up returns in this 0% risk-free world. So, whatever invisible leverage is under those guys is going to be manifest in stark fashion when this crisis comes around, and it's just going to amplify that pension bailout that I think will ultimately have to happen as a result.
Yeah, it's a much, I mean, we know it's bigger. Again, I'm going to keep working on it, because I do think I'm probably going to lose private equity clients once I quantify it, if I can. I don't care. I mean, I really don't. I want to live to the next cycle, as you and I have. Multiple times. And I think that's one thing we have that's unique. We're the same age. We've gone through, and not unsuccessfully, when other people got smoked. So at least we have some, a little bit more than the Portnoy thing. And by the way, he's probably going to come at both of us for saying that. I'm wearing a blue jacket, and I'm from Yale.
Bring it on.
So, you better watch it. You better watch it. No, anyway. So slide, the first one that I want to show, this slide. So again, you called this one everyone in the pool. This is like, why does this matter? By the way, I owned this, like the Charlestown Chiefs, I owned it up until 2 days ago. This is, because I was like, okay, I'm gonna just buy the damn thing because I'm short junk against it. And if the Fed's gonna buy it, then I'm just gonna own it.
Right.
I couldn't believe how much I got paid on being absolutely wrong fundamentally on that. So I just sold it. I'm like, this is ridiculous. That they got LQD up to where it is.
Yeah, it's stunning. I mean, and it does make you wonder, can they succeed in ring fencing all of the the weakest links in the credit market? I mean, they did that. They really resuscitated issuance in the credit market, in the IG market anyway, without buying a single bond. And then they just announced that they would be implementing these programs, and they did nothing, and the markets moved. And then when they actually did come in and start, buying with this fund, then you get another giant leg up. I mean, it's amazing. But
Powell said, "Don't worry, I don't want to be like an elephant."
Right.
Very serious man when he talks. Completely. I mean, I think, and we're going to get into this. I mean, I think like the comments on inequality gaps, like the Fed, me. I mean, he plays the part perfectly. You ever see a great lawyer who will, to the death, because he gets paid to do it, defend the client? I mean, he is awesome, like at that. Anyway, I digress. But the next chart on Triple C, like the real crap. What does this tell people?
So, I mean, this is, again, it just highlights that the problem isn't solved at all. Yes, the Fed was able to get, the lowest quality rungs of the corporate credit market to rally on the heels of their, various programs. But ultimately, the yield that those companies are paying is so much higher than it was a year, 2, 3, 4 years ago. And it's a pressing issue, because contrary to all the assurances we were given over the last several years, these companies didn't shrewdly lock in low rates as far as the eye can see. They were borrowing short term, as evidenced by the fact that we have this monster wave of corporate debt that's rolling this year and next. I think the number this year for corporate credit that has to roll is almost 900 billion, and next year it's over $1 trillion. And obviously in the investment grade space, they've been able to get a lot of that debt rolled thanks to the Fed's programs. But these guys, Triple C, they're going to have to roll that debt at higher rates. And most of them don't have the cash with which to pay any increase in debt service, much less the magnitude of increase that we're looking at on that chart.
Yeah, that point is one of the most important points. If you didn't hear it, rewind what we said. Because again, the debt that's about to mature, not 2020, which is by the way, 850 billion, I think, when you add it all up. But it's next year and the year after that. And this was exactly what happened in 2001, 2002. It's the workout period. It's the cycle. It's the profit cycle, stupid. You can't do it when cash flows are negative.
Well, the amazing thing is this illusion that the corporate sector is in great health, or was going into this, has been really fed by S&P earnings, which have been wildly inflated by the share buybacks.
Yeah,
so
and tax reform, which is a function of the buyback.
Yeah, so I think people had this warm and fuzzy feeling that we don't have to worry about companies being able to service their debt because they've got plenty of profits. And on top of that, look at the $1.8 trillion in cash sitting on corporate balance sheets. Meanwhile, at the top 3 companies in the S&P 500 have more cash than the bottom 400. I mean, it's amazing when you think about the gap between the haves and the have-nots in the corporate sector. And that brings you back to that triple C rated chart. None of those guys have any cash to absorb an increase in debt service. And it should go without saying right now that none of them are turning a profit either. I'd venture to guess.
Well, this is like, so guys, go to my deck on slide 88. What Steph just said, there needs to be a picture on that. And again, I think the opportunity, Steph, for people like you and I, and for really the country, is to actually, the words coming out of your mouth should be numbers. They shouldn't be bullshit, okay, or political bullshit. You know, this is where the street started at the beginning of the year.
Yeah.
They expected earnings to have one down quarter, which was mathematically impossible on my scorecard. I thought they'd be down 5 to 8, dead wrong on that, but they're going to now be down more like 28 to 58% in the next 2 quarters. But that's, if you had that expectation, if that's the line you saw, you bought the living daylights out of every rancid POS piece of credit that you could find because you thought that earnings were going to improve, and that's when you do buy credit.
Yep. Well, that's like getting back to your question as to what was going to be that unnamed catalyst. That was the one that I thought was going to be the catalyst, was that the expectations for earnings would be met with disappointment, and that would lead people to reprice risk in the corporate credit market. So now the problem for you and me, Keith, is that people will dismiss that earnings number as, oh, it's just COVID.
Oh, yeah, you got to look beyond it.
Right.
Yeah.
So.
Well, I don't think the people at Chesapeake or at, actually, the Oracle this morning had to announce reality. So did Norwegian Cruise Lines. That's what is actually most interesting to me is that, and a guy by the name, I'm sure you remember him, Dan Benton from Pequot Capital, that's bringing a blast from the past, right?
Yeah.
He was an old bear, I think, when you were back in 01, 02.
Oh my gosh.
But he used to always say that, there's macro season and there's earnings season. And as a younger analyst, I would have said, okay, yeah, that makes some sense. So I started paying more attention to the macro. That's actually how I got into this. But earnings season, I think, is actually, when people say, what is it? Well, it's the companies reporting reality. I mean, the bonds still trade, the stocks still trade. And by the way, a lot of uninformed people own a lot of these things now. So it's kind of an interesting setup. You said something about downgrades. The next slide, actually, what's interesting is when even the rating agencies are figuring it out. I mean, it's not exactly like they're the leading indicator stuff.
Absolutely.
So what's the point that you're trying to make here and on the next one, for that matter, on default rates versus spreads?
Well, I guess the point I was making there was that actually, I should have drawn that line instead of at March 22nd at April 9th. April 9th is when the Fed announced its panoply of corporate credit facilities. And as you can see from that chart, it has in no way arrested the parade of downgrades that we've seen since. I mean, and actually this one is only through MIDS from an older report. But the latest tally on total downgrades is over 1,200, which is more than we saw in the entire year of either 2008 or 2009. And we're only 6 months, not even, into the year so far. So we're going to blow those numbers out of 2008 and 2009 away. And I guess what I really was getting at on this chart is that green line is the junk downgrade trend.
Yeah.
So this was the whole idea for the Fed was because they can't lend directly or even indirectly to companies that have the risk of going insolvent. They were hoping that if they can support the investment grade market, they'd effectively ring fence the rest of the market. The positive vibes would feed out and help support junk. But meanwhile, the downgrades continue apace in the junk space. And so what they've done so far has not arrested the deterioration in credit quality on those weakest links. And as you know, downgrades lead defaults, which will be farther down the pipeline. But you look at that chart, you don't have to sit around waiting to see the defaults. You'd be a schmuck to sit and wait for the bodies to float to the surface. They're coming. It's time to get out of the pool.
This is why the tights in the credit market happen well before the market starts to implode. It's also why I started shorting small caps in the fourth quarter of 2018 or junk back then. The stuff has already been shaking and breaking. Now you're blowing it out is the point. And the other point that you make, which I'll show you guys on slide 96, high yield spreads as a leading indicator. Okay.
Right.
Now, here's a good example for the people that watch me rant, unfortunately, too often. My chart, yours goes back further. Okay. So I always say, can you see this chart, by the way?
I can.
Okay. So the bulls want this to be episodic, as Mandelbrot would say, and non-trending. And I want to tell people that this is, as Mandelbrot would also teach you, is that a spike in volatility can be non-episodic, and that cluster can be the beginning of a new trend. So again, going back for a decade now, it's been episodic and non-trending. The widening of credit spreads, it was a buying opportunity for people that are 32 years old that have only been a credit analyst. They've only seen a bull market until most recently that they had to be bailed out of, but I digress. The thing about 01 to 00 to 02 is that you have chronic spreads widening. And in your chart, actually, I think you have it on the next one, on her fourth chart. You pull it all the way back, and it's a friendly reminder to what happened between 1987 and 1991 recession, which is high yield spreads were chronically wide. They didn't come back, like the green line. I think that's a green. Yeah, in your chart, it's the green line, right?
Yeah.
So what is it? Is that a simple enough way for somebody who doesn't do macro but knows everything about don't fight the Fed, I might add. They know everything other than this, which is, is that a simple way to say it would be different this time if the green line on your chart doesn't stay chronically wide?
You rendered me speechless. I guess I'm trying to think back on why it did in the 87 to 90 period, and whether, the spread obviously is a function of two things. It's a function of what the Treasury yield is doing and what's going on in the corporate market. So I guess the question is, I look at the current environment and say, we know one thing, and that is that Treasury yields can never go up, right? I mean, if Treasury yields go up, it's lights out for the economy, it's lights out for the financial markets. So a widening of spreads necessarily has to be the consequence of 100% risk aversion. It's just a function of credit risk. It's not the economy stronger, we're demanding a higher inflation compensation or anything like that. It's all just a credit risk. And so I guess that's the question is, are we in an environment I could see where spreads stay super elevated for a long time rather than spiking up and coming right down, because the Fed is going to have to hold those Treasury yields down, I would argue, permanently.
Yeah.
And so, maybe you'll see spreads blow out and then come down a little bit, but essentially you're never going to see, a sustained period where they compress to where they've been in the last, as you said, this whole experience that no one's ever lived through anything but a bull market in credit. I think this will be the anomaly in hindsight, and that you'll see a period where, surprisingly, you have elevated credit spreads for a long time.
Yeah, and that would be 100% consistent with a negative corporate cash flow cycle. That is, unless it's different this time, that's what I tell all my friends and foes. It's just what it is. Okay, if the Fed is bright enough to eliminate that, then I'll take my ball and go somewhere else, at least for a little bit. In the meantime, I'll own treasuries and gold, by the way, which is fantastic.
Yes.
Because that's the other side of the trade. And people, I wish more human beings, and I mean it quite seriously, there's so many people that just don't have any savings and don't have anyone communicating that there was a way to protect yourself, treasuries and gold being the most obvious, on that point that you made, which is, there's no way that bond yields are going up for real. I mean, have you watched Japan? Have you watched Europe? I mean, if you didn't, then you wouldn't know that. But how about on this, like your next chart, slide 5, guys on the deck? I talk about this a lot. People kind of, they go to sleep when I talk about this cycle, the C&I lending cycle, or this commercial bank loans and leases as you're showing them. What is it about this that makes it not come back the way that a V-shaped recovery would want that to look like?
Well, I'm very impressionable. So let's just say I have a couple emotional scars from my investment career, and one is that chart of long-term bond yields and financial crises ticked off on there, and you see that we're having financial crises at lower and lower levels of interest rates. It takes less of an increase in rates to completely kill the economy or whatever asset bubble. So that gets into why I think treasuries can never go up. The other thing that I've been really had emblazoned in my mind is the shift, these sort of generational shifts in behavior. And I heard legends about, people who grew up during the Great Depression, who were always super concerned about their finances. And even if they made plenty of money to go out and spend, they would always really try to save, and they never took on debt, et cetera. So you're so scarred by the experience of your economic experience that it changes behavior for a generation. And we saw that after the housing bubble bust, where consumers came out and they had this new normal where they were spending at a much slower rate of growth, and the saving rate, as we've seen over the last decade, has been really surprisingly high relative to, again, this rampant inflation in financial assets, where normally you'd see household net worth go up and people would say, hey, my house, my 401k are all saving for me, so I'm not going to save out of income, I'm going to go spend.
Yeah.
So it was a really important window into a shift in consumer behavior. One which I think, is still ongoing. I can't imagine that after this whole COVID debacle, that consumers are going to come out of this and say, hey, you know what we need to do? We need to save less and spend more. I mean, I think what they learned was, hey, as much as we thought we were trying to be responsible before, we need to do a lot more. And so I see that as a further restraint on consumer spending, which, if you're simple about it, is really the lion's share of the U.S. economy. So if you think the engine of the U.S. economy is going to revert to a slower rate of spending, then you're talking about, less profits for corporations, which translates to less employment and wage growth. That's the number one input into hiring and wages is profits. So I see that unemployment rate, this is a very long-winded way of getting to your chart, which is, that spike up in the unemployment rate, which is being dismissed right now in terms of the implications for credit quality in the corporate space, as not necessarily going right back to where it was before, or even close necessarily. I mean, I think everyone understands that we're going to have a higher level of unemployment after this. The degree to which it's how much higher. And then again, I don't think people are connecting those dots between, well, if we're having higher unemployment, then you're going to see inevitably a wave of delinquencies, not just in the corporate consumer space, but in the corporate space as well.
Yeah, I mean, because we basically, private equity in particular, is zombified a lot of these companies that, and this is the last chart from you. I want to, and by the way, if you have questions for Steph, pop them in the queue. We'll go to those next. But this chart, which shows, this is a great, I hadn't seen this before. Yeah. I mean, again, showing the diminishing returns associated with all this credit. I mean, that's an incredibly bearish chart, despite the bull market that we had when earnings were actually accelerating. By the way,
yeah,
I was fine with that part of it. But this part, nah. Now you don't have a job, you're scared out of your mind, you're raising cash and savings, which we can see in every rate of change data series that's been reported
Yeah.
so far. But isn't that sad? Like that, that's an American chart. That to me would look like a European chart.
Well, what's really stunning about this, and it does feed back into that chart of, long-term bond yields and financial crises, where, the U.S. economy, thanks to the Fed for basically the better part of the last 30 years, has been encouraged to just take on more and more debt as a solution to every credit crisis. Every time we get in overhead because we borrowed too much, the Fed rushes in and says, hey, you know what you need to do? Borrow more. Here's 0% rates. Take advantage. And so, not surprisingly, we end up getting into an even bigger debacle. So we ping pong from one asset bubble to the next. And each time, what happens is it takes more of this Fed credit juice to generate the same amount of oomph in the economy. And this chart, Keith, is actually through the fourth quarter.
Yeah.
We just got the latest flow of funds. I'm such a nerd, but on Thursday last week, we got the flow of funds. And the latest number on that is it takes $7.50 to generate it. Sorry, $7.50 in borrowing to generate each $1 of GDP growth.
Oh, that's awesome. That's awesome.
It's worse than, we've never seen that since 2009. It's a horrible, horrible situation. And it just makes you wonder, like, okay, so does the Fed not realize that not only are they just inflating bubbles all over the place, expanding the wealth inequality, but they're also getting less and less benefit economically from doing this? The GDP response that they're trying to get with these defibrillators is non-existent.
Yeah, so it's non-existent, but who's getting paid on it is private equity. And people hate it when I say that, but it's true. You're putting more and more and more and more leverage on top of melting ice cube.
Yeah.
And you're paying yourself more and more and more fees. And once the ice cube goes away, the people lose their jobs at those assets and you keep yours. It's like the craziest thing that I actually wonder if Biden has it in him or Trump. Either person, just explain it.
Yeah.
I think if you could just explain it. Guys, slide 128 on that. I just want to get Steph's comments. This is my I think it's 128, hopefully it is, or it's 126, the inequality chart, because I know that you have some views on this. I try to use this as, anytime I get into like a fist fight, a rhetorical fist fight it's usually with a potential subscriber institutionally, and then they just don't like me. But some people love me. It's not about being loved or hated. It's actually about knowing this time series. It's pretty simple. It's labor against capital. Obviously, private equity is capitalized on the blue line going down for 2 decades. Again, you can just lever up the black line, pay yourself, and then screw the people. Once the asset's gone, roll into the next one.
Right.
Is that observations of the blazingly obvious or not?
I think people should understand this, but they clearly don't get it. I think, the window into that, you've got your private equity angle, even in the realm of, regular corporate America. You're just buying back shares and shoveling it at your shareholders, and you're squeezing out labor and wages. And that's just been the story. And we wonder why we have this massive inequality, wealth inequality. And then you get Powell, and it's so, I think it's disingenuous. Maybe they're really that clueless. But, he talks about how the Fed doesn't want to, he was asked the question about, do you worry about whether you're inflating bubbles? And he kind of got on his patriotic high horse and talked about how, the Fed needs to really focus on supporting basically the little guy on Main Street. So whether they inflate a bubble on Wall Street is sort of secondary. They really need to protect the little guy. I'm thinking, can you really be this ignorant to the fact that you're doing exactly the opposite? Meanwhile, you've got these day traders who are running in to buy Hertz who are going to get destroyed if they haven't already. And then on top of that, apparently we now have the return of the home flippers. I don't know
Yeah.
if you saw this, but home flipping is now the largest share of total home sales since, guess when? 2005, at the peak of the housing bubble. So this is all going to end badly, and no one's going to be hit harder than the guy on Main Street, because not, if he's not day trading or he's not flipping a home, his pension is going to be completely bankrupt. So this is just, it's not the folks on Wall Street and your private equity guys or anyone else that's going to suffer the worst. It's going to be Joe Sixpack, who's suddenly going to have to get, on some government handouts to be able to stay, sustain an existence, much less have a retirement.
Yeah, and before I get myself into the trouble that I'm already in, on private equity, and agree. I mean, it's what's the difference between an airline executive levering up his balance sheet, buying back stock to lower the earnings per share, pay himself his bonus on a higher earnings per share? I mean, you're doing it. Just say it. Like, I wish somebody, like, everybody loves Jamie Dimon as this great leader. Well, why don't you just tell the truth, man? Like, where I'm from, my dad's a firefighter with a big pension, by the way, that he hopes to get paid on. Where I'm from, you got to just tell people about these things. And by the way, it would be, my dad's 38 years in. I mean, what is going to happen to people like that? It's going to happen, and it's going to happen abruptly, and it's going to happen to not the people that are getting paid, which is basically Wall Street. And again, I think if you read Steve Schwartz, just take the god of private money himself. He'll tell you that himself. Steve Schwartzman, the king of capital. Read his own book, or at least the one he signed off on. Every time we get to this part of the cycle, he either changes partners or it blows up, because that's the cycle. He knows this too. Private equity knows this. They may not like this, and they definitely have the right guy in the seat to prevent defense against this.
Right.
But it doesn't mean that this goes away. I mean, so...
or that we don't have to face the consequences of it. I mean, you look out your window and you see people in the streets. I mean, that's a real life sort of endorsement, let's say, that's not the right word, of this gap between perception and reality. We're talking about the economic reality isn't anything near what these buyback inflated earnings and other, private equity, shenanigans suggest it to be. But it's amazing to me that hasn't sort of gotten people awakened to the reality that there is this huge gap and that it's not going to be resolved in some easy manner. I mean, clearly there is a large constituent out there that's been disenfranchised, and that's now.
I mean, it's
imagine what.
And now, to me, might get worse. I mean, this is actually question number one here, and it doesn't surprise me because we haven't talked about it yet, from Bob, which has to do with the dollar and a devaluation of the dollar. So again, I actually got a lot of feedback on this, not so much from Wall Street clients. It was kind of generally mum, like it would be on a topic like this. But I have a lot of mass market subscribers, high net worth people, et cetera, that really liked the note. It was about the Fed's dollar devaluation and how that impacts a person without a job or somebody who's got just a low income job. If you raise their cost of living with a devalued dollar in dollars, commodity prices go actually up, and how that works. What are your thoughts on that, the dollar, and what stagflation is what I was trying to articulate for the low to middle income earners would look like or could look like from here?
Yeah, no, I'm totally with you on that.
You are? Okay, good. Well, thank you.
Yeah, no, I think number one, as relates to the dollar, the standard pushback you get on that is just, where am I going to go? The dollar's the cleanest dirty shirt. There's no alternative. There is no currency around the world that could possibly compete. Meanwhile, if you look at the allocation of dollars as a share of global forex reserves, they're shrinking and have been for many years. So clearly, we have this sort of arrogant assumption that the rest of the world has no choice but to recycle their dollars here, and there is nowhere else to go. And in reality, they are finding other places to go and other things to do with their money, whether it's buy, oil or gold or whatnot. So that's one thing. I guess as relates to the implications of that in terms of the regular guy and the cost of stuff that he's buying at Walmart or commodities, It's so real, and it's been going on. We've seen this stagflation. I guess, I use the word stagflation. What I'm really thinking about more is PPI, in other words, input price inflation,
Right.
at a time when there is really very little CPI, consumer inflation outlet. So you've got this sort of, again, it's like the haves and the have-nots. You have the goods and services that people have no choice but to spend money on, where you actually do see inflation. And then you've got all the stuff that's discretionary, where you have massive disinflation. So I think that gets into why I've been so negative on the outlook for corporate profits in various sectors, is that you've got a consumer that really doesn't have the ability to absorb a generalized increase in prices across the board. If they have to pay more to buy their groceries or fill their gas tank, or for insurance, they're going to have to cut back on vacations or iPads or whatever discretionary items. And you've seen this play out. I mean, we've seen, not now because all the numbers are all over the place, but a period where you had a much more steady increase in PPI inflation than the CPI. So basically, companies were seeing their input costs go up faster than their ability to pass them along, but they were able to disguise that by buying back their shares and inflating the earnings. So it was all irrelevant. Good. Yeah, all good. Exactly.
Yeah, all good until it's not. And the election definitely, there's a gap on being able to do that. There's probably a bigger gap on being able to basically bail out corporates. I think that the people want to get paid, and that's where the votes most likely are. That's just an opinion. But this other question probably has to do with work that you've written on. It's a follow-on to what I call Quad 3 stagflation, which is quite damning for corporate profits, to your point. But whether the difference between realized inflation and inflation expectations, like how you're looking at that.
Well, I mean, I guess Japan is the perfect example of the dangers of deflationary expectations. And the objective for the Fed is obviously to try to get people worried enough about prices going up in the future that they start to stockpile things now, and then it becomes a self-fulfilling prophecy. As they run to buy things now that they think will be more expensive later, they create the inflation that they're fearing. And I guess I think it's really tricky, as it was in Japan. What we're finding is the longer people have been left in an environment where prices have been going down, the less likely they are to believe that they're going to go up. And I guess, again, it gets into different things. If you're talking about food prices or college tuition or health insurance, people's perceptions about where prices would go would probably be different from, technology and other areas where things have been deflating. But I think this is really the struggle, and the Fed really is trying to get inflation expectations to go up. And meanwhile, the irony of it, and I describe the Fed sort of, their policy as sort of the Costanza policy, where it's effectively the opposite of everything it's intended to be. Just like George Costanza finds that in life, his life has turned out to be the opposite of everything he hoped it would be. But essentially, by holding down rates with the idea that they're going to spur growth and inflation, the Fed is actually depressing growth and feeding disinflation by, keeping zombie businesses alive, and they destroy margins across their respective industries, making it impossible to raise prices. And then they depress spending by taxing all the people who are trying to save for retirement. And, in an aging economy, that is a major drag on growth.
So it's obviously getting untaxed earnings. That's another, Pandora's box, depending on who wins the election. I don't want to get into that, but I do. But we only have so much time. We only have.
Right.
I got 4 minutes left on the clock, and this question I'll just ask. Like, there's a variety of questions like this. I have to answer this a lot. This is the. It does get downvotes, by the way. But
we're going to ask it anyway.
Is it possible? This is the infinity question. Is it possible to have an indefinite bubble economy where central banks just buy stocks and bonds every time the yields surge and prices fall 5 to 7%? Many papers at the Federal Reserve, et cetera, said that the Japanese mistake in 90 was to prick the bubble. They should just keep pumping it.
Yeah. This is my nightmare.
That's, I mean, there's got to be, I mean, if that's not the consensus expectation, it's the consensus market position.
Right, absolutely. That's a good distinction to draw for sure. You're punished for positioning a revenge of the fundamentals right now because the Fed is standing there saying, we're going to do everything we can to prevent the fundamentals, or gravity as you describe it, from ever exerting their inexorable force. And I guess I am just a moron because I still worship at the altar of the fundamentals. I still believe in gravity, and I don't think that they can do that forever. And, I come back to, let's say they're able to keep bankrupt businesses going for a while. Ultimately, if consumers aren't going to go out and buy products and spend the way they did before, those earnings aren't going to be there. And you're just basically delaying the inevitable. Maybe the Fed can hold this together, hold the credit bubble together for a while, but it can't do it forever. And I think that maybe the glimmer of hope, and that's going to sound bad to say in this framework, for me, is that, when you see what the Fed's done just in the last week, it smacks so much of desperation.
Yeah.
They announced that the secondary corporate credit facility on April 9th, and we knew it was coming. And they came in and started using it after the market was down 1,800 points one day, and failed to really rebound. So I feel like it's not accidental that that's when they came out with this announcement. And then if you look at the market reaction, honestly, I don't think that the market reaction was anywhere near as impressive as they probably hoped it would be, especially when you consider that it came at the same day that Trump announced $1 trillion infrastructure bill. So I think that the Fed looks like it's getting less and less respect for the efforts that it's making. And if that is in fact true, it's going to be really ugly when we get through this coronavirus phase and we get to the data on the other side, and it's clear that the economy did in fact have other issues that were much larger than just this short-term lockdown phenomenon.
Yeah, that summarizes a lot, and thanks for that, because and some people are like, oh, you guys are just going to agree with each other. Well, thank God for that. Like I don't see this conversation in other places. I'm sure it's happening. I don't mean to say it doesn't happen, but it's infrequent, suffice to say, given the noise that people are being pumped every day, to be able to listen to a conversation like this. Of course I want to have a discussion about this. I mean, I live in this country, I have 4 kids, I have a firm, I care about the American capitalism, even though it's like you need a Canadian to tell you how it works. Come on.
Right.
Like, I mean, I do think that this is a super important discussion that we had, and I agree with you too, it does smack of desperation. Not everybody looks at it that way in the moment, and that's actually, I think, the mistake. But if you look at it within the trend, like as we've been talking about secular or both, I mean, there's no such thing as a bull market when the VIX today is at 33. I mean, that's the best the Fed just did, is that they announced that the other day, got you to buy a bunch of other stuff. The only thing they haven't bought yet or said they're going to buy or not is stocks. That's it. Then what?
Right.
The VIX is still at 30. Bear markets live and breathe between 20 and 30, the starts of them, and they're going to bleed people out between 30 and 50 VIX. We know that. So if anything, I've thought that their panic and their desperation has perpetuated the worst thing for any market. It can be anything. Which is, it's perpetuated volatility. And volatility is not what bull markets are made of. So anyway, we're out of time, and apologies to, I wish I could just keep talking or having this conversation with you, and it's,
me too. It's like relief to be able to talk to someone like
it's like
who agrees,
It's there. It is. It's there. Now I have to go back to the nut house and get on calls where like I'm the moron, just like you. So at least like this was great.
Yes.
Instead, she's from MacroMavens. I'm Hedgeye. We're two morons. And if you want to do the other side of the trade, well, we should have this conversation again.
I look forward to it. Thank you so much, Keith. This is fun.
All right, thank you. Thank you so much. She's Steph Pomboy. You can find her on Twitter. My last tweet, I actually highlighted her. She's fantastic. And I hope you really consider the economic gravity of the situation. She certainly did a great job articulating that.